Want to grow your passive income with real estate, but without buying the properties yourself? Well, you're in luck because real estate investment trusts, or REITs, allow you to invest in real estate just like you would with stocks. In today's video, we'll cover everything you need to know about REITs, what they are, the benefits, the different types, the risk associated with them, the tax implications, and how to choose the highest quality ones for your dividend portfolio. I will also show you my entire REIT portfolio. So let's get started. Hi, this is Jeremy. Welcome to Dividend Stockpile. We are income investors focused on passive income and growing our wealth through dividends and options income. If you like that approach, please join along by subscribing to never miss an episode. First off, what exactly is a REIT? Well, REITs, or real estate investment trusts, are companies that own, operate, and finance income-producing real estate. They allow individual investors to pool their money to invest in large-scale properties like office buildings, shopping malls, apartments, and more. And the best part? REITs are required by law to pay at least 90% of their taxable income to shareholders in the form of dividends. So you get a slice of that real estate income without ever owning the property yourself. Now, why should you consider adding REITs to your portfolio? Let's break down the key benefits. High dividend yields. Since REITs must distribute 90% of their taxable income, they tend to offer attractive dividends, making them a great option for income-focused investors. Diversification. REITs allow you to diversify into real estate without the headaches of owning the property. You can get exposure to a variety of sectors such as healthcare, commercial, industrial, and residential real estate. Liquidity. Unlike physical real estate, REITs are often traded on stock exchanges, so you can easily buy and sell shares like any other stock. Inflation protection. Real estate generally appreciates over time, and many REITs have leases with rent escalations tied to inflation, providing some protection against rising prices. Not all REITs are the same, and there are several types to consider, depending on your investment goals. First, we have equity REITs. These are the most common type of REITs. They own and operate income-generating properties, like shopping malls, offices, and residential buildings. Then you have mortgage REITs, or MREITs. Instead of owning the property outright, MREITs lend money to real estate owners or purchase mortgage-backed securities, making their income dependent on interest rates. Then we have hybrid REITs. Those are a combination of equity and mortgage REITs. These REITs both own the property and invest in mortgages. And we have specialty REITs. These focus on niche markets like data centers, self-storage units, or cell towers. Companies like Public Storage and American Tower Corporation are examples of this type. REITs are a powerful addition to any diversified dividend portfolio. Here's why. Income generation. With their consistent and often high dividend payouts, REITs can significantly boost your income stream, making them a staple for dividend investors. Non-correlation with stocks. Real estate returns don't always move in tandem with the broader stock market. So, adding REITs can help smooth out a portfolio volatility during market downturns. And they provide sector-specific opportunities. REITs provide targeted exposure to real estate sectors that may outperform in specific economic environments, such as industrial or healthcare properties during growth cycles. Like any investment, REITs have their risks. First is interest rate sensitivity. Rising interest rates can negatively affect REITs because borrowing costs increase, and the yield on other income investments like bonds becomes more attractive in comparison. Sector-specific risks. Different REITs face risk depending on the real estate sector they focus on. For example, retail REITs may be hurt by the rise of e-commerce, while office REITs might struggle in the age of remote work. The liquidity risk in smaller REITs. While most REITs are liquid, some smaller or less well-known ones may experience lower trading volumes, making it harder to sell shares without impacting the price. When it comes to evaluating a REIT, the traditional price-to-earnings ratio, or PE ratio, doesn't work well. Instead, investors rely on these metrics. First up is funds from operations, or FFO. FFO is the most common measure of a REIT's cash flow, adjusted for real estate depreciation, which is a non-cash expense. FFO gives a better sense of a REIT's true earning power. Second is adjusted funds from operations, or AFFO. This goes a step further, deducting capital expenditures and maintenance costs. AFFO provides a clearer picture of the cash flow available for dividends. And then we have net asset value, or NAV. NAV estimates the market value of a REIT's properties minus their liabilities. Comparing the share price to NAV helps investors assess whether a REIT is over or undervalued. One important aspect of REITs is the tax treatment. Unlike qualified dividends from most stocks, REIT dividends are generally taxed as ordinary income. This means they're subject to your higher income tax rate. However, REIT investors may qualify for a 20% pass-through deduction under the Tax Cuts and Jobs Act, which can lower your taxable REIT income through 2025, and at that point it is up to the government to decide whether to extend or cancel that benefit. Additionally, to maximize tax efficiency, many REIT investors hold REITs in tax advantage accounts like IRAs or 401ks. Now we're going to transition to my individual REIT portfolio. For that, I'm going to be showing you allreits.com. They are, in my view, the premier research and analytics tool for real estate investment. If you like what you see, I have a special offer for you to get a discount on their service at the end of the video, so stay tuned. Now remember, I'm not a financial advisor. This is not financial advice. These are just my picks for my REIT holdings. You need to do your own research and due diligence to make sure that they fit your needs. And I love All REITs for that. So definitely take a look. All right, so now we're here inside allreits.com. As I mentioned before, they are the premier research tool for REIT investing. I am a premium member and I wanted to utilize their service to show you my REIT holdings. But before we get into that, I kind of wanted to do a brief overview of what their site offers. Again, it's allreits.com. So they have a bunch of different options. The first one is the portfolio. So you can add either a watch list or your actual portfolio, and it will track it for you and all the metrics you need. It has a REIT screener where you can search for a particular REIT, either by the sector or the individual company name and so on. And they also break down all the different REIT sectors. Like we talked about earlier, you have the retail, you have industrial, you have office buildings, you have all those different types. So you can look by the sector and find companies that fit your needs and your investment criteria within this tool. You can also search for a REIT directly just by going to the magnifying glass, or you can do a search down here as well. But scrolling through, I just wanted to kind of look through their site. This is their homepage. So they have REITs in many different markets. The United States, of course, is the main one, but it breaks down the different sectors of the REIT universe, which ones are doing well today, which ones are not doing so well today. They have the popular REITs based on, the number of views on their website. You can change it by the time period. Also has all the different related news on real estate, as well as in particular lists that you can utilize to get ideas on types of dividend REITs to purchase. If you scroll down some more, you see that some of the other markets like Canada, Singapore, United Kingdom, France is in here. There's a lot of different countries and regions that you can look at if you want to find investments in other markets outside of the United States. Okay, what I utilize it for is to understand which real estate investment trusts I want to purchase, as well as the current metrics. So the way I'm going to do that is I'm just going to show an example. I'm going to do O, which is a realty income, just to show what everything looks like. When you pull up an individual company, it gives you a summary of the company themselves, some of the highlights of their metrics, and they have this great tool that they have over here where they have a ranking system. So between 0 and 100. And anything over an 80 is green and is considered good, but they do it based on 6 metrics, as you see here. Years since IPO, adjusted funds from operations, or AFFO growth, the share growth, dividend growth, the payout ratio, and the level of debt. So Realty Income, of course, is a very solid REIT, and it gets a 100 score. But going down further, you can see what the current price is and the historical price. If it's on a discount to their 52-week high, you can see what their price to AFFO for valuation. You see it's trading at 15 times AFFO. Their 5-year average is 15.5, so it's slightly undervalued, just barely. Shows you the total returns, dividend yield, and dividend history, as well as their projections on forward dividend growth and their dividend payout ratio, which is very important when it comes to real estate investments. One thing I really like is this yield benchmark. So you can see how the current company you're looking at, the yield is compared to their own historical average and all of the other REITs in the industry, as well as all the REITs in general in the United States. And then it gives you a detailed breakdown of all their financials. So the history, the compound annual growth rate, their debt levels, occupancy rates, who their largest tenants are, and then it goes into all the details of the financial reports. So you can look at the current year, you can look at previous years, you can find out the averages. If you take it and scroll over to the side, it goes from the basics of the company to some of their assets and debt levels, debt maturity, what interest rate their debt is at, how much interest coverage they have, current yield and payouts, number of properties, on and on and on. So it gives you a great sense of the company and a straightforward high-level chart. It also gives a breakdown of what types of properties they have, where they're located, the types of tenants, and so on. And it also provides all the recent news from around the REIT universe and that you can find about that individual real estate investment trust. If you don't know the exact company you're looking for, you can go to the screener and you can rank it by sectors. You can rank it by their score, the price to earnings. You can do it alphabetical. You can adjust the screener any which way you want to get an idea of what's out there. All right, so that's all REITs. I do recommend them if you're interested in real estate investing. It's a great tool. As I said before, we have a discount that we're able to provide viewers of this channel. So stay tuned and you'll be able to get that discount code to sign up for their premium membership like I have. All right, so all that, now I'm going to talk about the real estate investment trust that I own. And I'm going to go in alphabetical order just to make it easier for everyone. This is not necessarily my largest or my smallest, it's just alphabetical. So the first one is Agree Realty. As you see here, it's a fully integrated REIT that develops single tenant standalone properties. So triple net lease. It gets a score of 100 from all REITs. The price to AFFO, sorry, is slightly higher than the five-year average. So it's possible that it's not the best time to purchase this one in particular, but it shows you their annualized returns, their dividend history, their forward growth, payout, everything that we talked about previously. Talks about their financials. Looks like they have really strong compound annual growth rate of both their AFFO and the AFFO per share, which is what we're going to base our dividend payout ratio on. Looks like their occupancy is near 100%, and their largest tenant is only 5.8% of their portfolio. So that's Agree Realty. A lot of people compare them to Realty Income, ticker O, but I would say this is a smaller organization and a faster growing one than Realty Income. So if you're interested in that space, this is a good one to pick, and it's my choice for this sector. Next up, we have Alexandria. It's an office REIT that focuses on life sciences, technology, and ag tech campuses. So what they do is they rent out space to research labs and things like that, like your medical and your pharmaceutical teams, to do their work. And because it's a very specialized, technology-driven type of industry, they have to have very specific real estate. And so Alexandria focuses on that part of the market. Again, they get 100% from all REITs. Currently, their price to AFFO is only 12.3, so it's definitely under their five-year average. And you can see over the last few years they've struggled, but in the long run they've done very well. They pay a very solid dividend right now of 4.58%, and they have a low but solid dividend growth of the last 5 years, a little over 5%. And their payout ratio is relatively small at 56%, so that looks good. And their yield is well over their five-year average, which means they could potentially be undervalued. So this is Alexandria. Next up, we have American Homes for Rent, AMH, and they invest in single family homes and they rent it out to tenants. So what they are known for is developing entire neighborhoods and then renting out those particular rental homes. Again, they get 100% or 100 from all REITs. They've been around for 11 years and their current price to FFO is 21.7. So a little bit under their five-year average. And if you look at their total returns, they've done very well over the last 1, 5, and 10 years. Their dividends have been growing over the last couple of years, and their forward dividend growth is spectacular. Expected 18% forward growth, and their payout ratio is still low for a REIT, so it's still looking like a good thing. And their current yield is over their five-year average, which means they could potentially be undervalued. Here's some of their metrics of their financials. Next up, we have Apple Hospitality REIT, and they invest in hotels. So things like Marriott's and things, Hilton's and things like that throughout the United States. They only get a 90 out of 100, and that is because they've had to cut their dividend back in 2020 during COVID. But since then, they've reinstated it and they're almost back to where they were before the pandemic. And you can't really blame them. The entire world was shut down. No one was going to hotels. But they are on their way back, and their price FFO, AFFO is still lower than their 5-year average, meaning there's still value to be had there. Looking at the yield, is paying an impressive 6.35%, and they also pay occasional special dividends. So in addition to the regular standard dividend that they're paying, occasionally they pay additional dividends. All right, so you can see their yield is currently over the 5-year average, meaning they're probably undervalued. And looking at some of their metrics, you can see that generally speaking, they are growing over time. All right, next up, we have Equinix, which is a data center provider. So they operate the big data centers that all the cloud providers use. And this one has done extremely well over the last few years, as you can see. It is priced pretty high. It's at 26 times, which their 5-year average is only 24. So again, it's fully valued, if not overvalued right now. It only pays about a 2% yield, but their dividend growth has been fantastic. 5 years at 12.6, 3 years at 14.2. And their Always has an expected good dividend growth to be a little over 17%. And they have a very strong and stable payout ratio around 50%. But looking at the yield, again, it does look like they're fully valued, if not slightly undervalued. Looking at their financials, mostly up and to the right, good growth rates. Debt to assets is the only thing that is a potential weakness. But if you look at their historical amounts, they're usually right around that 50% debt to assets. So for this company, it seems to be in line. All right, so that's Equinix. Next up, we have Kite Realty, and they invest in community shopping experiences. So they do whole shopping centers. So if you're in the Southeast, you probably heard of Publix supermarkets. They have the entire centers around Publix and Walmarts and Whole Foods and things like that. And so they get 100 from all REITs. Their price FFO is a little pricey compared to their 5-year average. But if you look at their total returns over time, they've had very solid results. Pay about a 4% dividend, and they have a forward expected dividend growth of 8.3%. And they're right in line valuation when it comes to the yield. Next up, we have Lamar Advertising Company, and they're best known for their billboards. So they have billboards throughout the United States and internationally, but they also do buses, shelters, benches, and airport terminal logos. So they offer basically outdoor advertising for companies. They're one of the largest in the sector. They did get a 93 out of 100, and the only thing that's causing it to be down is their debt. Their price FFO is slightly higher than their 5-year average, but if you look at their total returns, they've done an extremely good job over the last few years. Again, solid dividend and very good dividend growth going forward. Again, their yield is a little bit under their 5-year average, which means they're probably fully valued, if not overvalued. And looking at their overall metrics, they're looking really good as well. Next up, we have Mid-America. What they do is they own apartment buildings and rent them out. So again, their AFFO growth and their AFFO per share growth is on the lower end or medium range. So that's why they got a 90. Looking at their valuation, they're a little bit undervalued compared to the historical average. Long term, they've done excellent. Their dividend has a solid growth history, and they intend to continue to grow it. So over the last 3 and 5 years, they've grown about 10%. All REITs is expecting about a 5% dividend growth going forward. And their payout ratio is slightly higher than their average, and that might be one of the reasons. But it is undervalued compared to their historical average when it comes to yield. All right, next up, we have Prologis, and they invest in logistics real estate. So your industrial centers, your logistics warehouses, things like that. 100 from all REITs. Their price FFO is under their 5-year average, so it might be a good value. If you look at the 1 year, the year to date, it's down. So that might be what's causing the good valuation, but over the long term, it's done extremely well. Dividends are strong and growing over the last 14, 15 years. And therefore, dividend growth is looking favorable, and it looks like they're undervalued based on their current yield. All right, almost done. We have Vici Properties. They basically own all the properties on the Las Vegas Strip, but they're also diversifying across the United States with 28 gaming facilities and 47 million square feet of space. So the only thing that's holding them back is a year since IPO, and they have only been around for 6 years, and that might be the reason why. Looking at their price to AFFO is under their 5-year average. Their dividend is growing very well, and their forward dividend growth expectations is 4.2 with a 77% payout ratio. Again, their yield is slightly higher than a 5-year average, so it might be fully valued or slightly undervalued. Okay, last up on my REIT portfolio is an ETF called IRETs, the iREIT Market Vector Quality REIT Index ETF. What this is a broad diversification, actively managed REIT ETF, and they look at the 100 REITs and identify the best in that sector. It is a brand new fund. It's only been around for a little while. The yield is currently showing is not a full yield because it hasn't been open a full year yet. But as it grows and it gets over that 1 year mark, we'll have a better sense of what the dividends are. But looking at their holdings, they have about 36 holdings right now, including Iron Mountain, Lamar Advertising, Host Hotels, Ryman Property, Weyerhaeuser, Equity Residential. They have a lot of different properties that some that I own and some that I don't own, but it gives a broad diversification throughout the REIT universe in the different sectors. So that's why I picked this particular REIT ETF to give me that diversification and someone else picking the quality names so I don't have to. So that's my entire REIT portfolio. Hopefully you guys enjoyed that overview. Definitely take a look at allreits.com. And as I said, stick around. I'm going to be able to provide a discount code if you want to sign up for the premium service. So there you have it. Everything you need to know about investing in REITs and a look at my own REIT portfolio. From their high dividend payouts and diversification benefits to the different types of REITs. REITs can play a crucial role in building a strong income generating portfolio. Just remember to be mindful of risks, tax implications, and to evaluate REITs based on FFO, AFFO, and NAV. As always, do your own research before investing and make sure the REITs align with your financial goals. I use allreits.com for all my research. They're offering a discount for my viewers of 10% off if you use Div Stockpile at checkout if you sign up for their premium plan. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to Dividend Stockpile for more investing content. See you next time, and remember, keep stockpiling those dividends.